Hey everyone, let's talk about something that's on all our minds lately. Inflation. Prices for gas, groceries, you name it, they're all going up. But have you ever stopped to think about how this affects the biggest debt most of us will ever have? That's right, I'm talking about your mortgage. The answer might actually surprise you, because depending on what kind of mortgage you have, inflation could either be your best friend or your worst enemy. Stick around because understanding this could save you a fortune. So let's break it down. There are basically two main types of mortgages, fixed rate and variable rate. Let's start with the good news. If you have a fixed rate mortgage, congratulations. You're actually in a pretty sweet spot right now. With a fixed rate, your monthly payment, the principal and interest part, is locked in for the entire term of your loan. It doesn't change, ever. So let's say your payment is $2,000 a month. 5 years ago, that $2,000 felt like a lot more money than it does today, right? That's inflation at work. As the value of money goes down over time, the real cost of your fixed payment is actually decreasing. You're paying back your massive loan with money that's worth less and less each year. In this scenario, inflation is literally helping you pay off your house. It's like getting a secret discount on your debt year after year. Slight shift in tone, more serious. Okay, now for the other side of the coin, the variable rate mortgage, also known as an adjustable rate mortgage or ARM. If you have one of these, you need to be paying very close attention right now. Unlike a fixed rate loan, the interest rate on a variable rate mortgage is tied to a benchmark rate set by the central bank. And what's the number one tool central banks use to fight inflation? They raise interest rates. So as inflation climbs, the bank raises its rates to cool down the economy. And when that happens, the interest rate on your mortgage goes up too. This isn't a small change we're talking about. A jump of just 1 or 2% on a huge loan can mean your monthly payments suddenly shoot up by hundreds or even thousands of dollars. Suddenly, that affordable mortgage becomes a major financial burden. In this case, inflation isn't your friend. It's actively working against you, making your biggest debt more and more expensive. So what's the big takeaway here? What's the smart move? It all comes down to timing. When you start hearing whispers of inflation, when economists are predicting that rates are about to start climbing, that is your golden window of opportunity. That's the moment to either lock in a super low fixed rate mortgage if you're buying, or to refinance your existing variable rate mortgage into a stable, predictable fixed rate one. By locking in a low rate before the storm hits, you protect yourself from rising payments and essentially set yourself up to let inflation work in your favor for the next 15, 20, or 30 years. It's a powerful financial strategy that can make a massive difference in your long-term wealth. So take a look at your mortgage statement, understand what you have, and always keep an eye on the economy. It pays to be prepared.